Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Exotic Options Explained, a guide to types, benefits, and risks. For example, a company exposed to currency fluctuations might use Asian options to lock in average exchange rates rather than betting on a single price. This creates a buffer against unpredictable market swings. Exotic options take traditional hedging a step further by addressing risks that standard tools might overlook. They allow investors to focus on scenarios that matter most to their strategy, providing a layer of security that's as nuanced as the markets themselves. Risks associated with exotic options. Exotic options can offer customized and complex financial opportunities, but they come with risks that traders must carefully weigh. While their unique features can provide upside, they also bring challenges that aren't always present in standard options. Understanding these risks is crucial before trading exotic options. Complexity and lack of liquidity. The intricate nature of exotic options can create challenges, especially for less experienced traders. Their complexity often results in reduced market participation, which directly impacts liquidity. Harder to understand. Exotic options have detailed features and payout structures that require more expertise to analyze. Misinterpreting them can lead to costly missteps. Fewer buyers than sellers. Since these contracts cater to niche markets, they tend to have lower trading volumes. This makes it harder to execute trades quickly or at favorable prices. Wide bid-ask spreads. With limited participants, the difference between what buyers are willing to pay and sellers expect is often larger than in standard options markets. Think of this as trying to sell a rare collectible in a small market. Finding the right buyer can take more time and effort. For traders, this translates into higher transaction costs and difficulty in adjusting positions when market conditions change. Market risk and pricing errors. Exotic options are not immune to typical market risks, and their unique features can amplify these challenges. Add in the difficulty of accurate pricing, and the risks can multiply. Increased sensitivity to market movements. Due to their tailored designs, exotic options often react more strongly to shifts in market conditions. This can lead to unexpected losses. Pricing complexity. Their valuation relies on advanced financial models and assumptions. Small errors can cause significant mispricing. Modeling limitations. Even sophisticated pricing models like Monte Carlo simulations might not capture every variable, leading to inaccuracies. Lack of standardized pricing. Unlike regular options, there's no universal method for valuing exotic contracts. This leaves room for inconsistency between traders and brokers. To put it simply, pricing these options is like trying to predict the weather weeks in advance. It's possible, but far from perfect. Even small errors in assumptions about volatility or market behavior can heavily influence returns. For traders, this cocktail of market risk and pricing uncertainty demands careful planning and often the guidance of financial professionals. Strategic uses of exotic options. Exotic options are more than just complex financial instruments. They offer traders the ability to diversify their strategies in ways that standard options cannot. Whether the goal is to speculate on market movements or generate additional income, these tools provide unique opportunities for those who understand their potential. Speculative strategies. Exotic options are a popular choice for investors looking to take calculated risks. Their tailored structures allow for speculation on specific scenarios that may be impossible or less attractive with standard options. Investors often use exotic options when they anticipate movements in an underlying asset but want more precision or control in their bet. For example, barrier options can be used to speculate on price levels. A trader might buy a knock-in option, which only activates when the asset hits a predetermined barrier. This decreases upfront costs compared to a standard option. Digital options allow traders to predict all or nothing scenarios, such as whether an asset's price will cross a specific level. These provide clear outcomes with no ambiguity. Look-back options are ideal for those who expect high volatility but can't predict exact market timing. Since the payoff depends on the highest or lowest price during the term, traders gain an edge. Because exotic options can tailor payouts and conditions to match a trader's view of potential market behavior, they are particularly well suited to speculative strategies. However, these bets require a deep understanding of the market and risks involved. Income generation strategies. Traders also turn to exotic options to create consistent income streams. While this strategy often involves more risk than traditional methods like dividend stocks or bonds, exotic options offer a creative way to enhance returns. Here are some ways exotic options are used for income generation. Sell barrier options. Traders can sell knockout options, allowing them to earn premiums as long as the asset doesn't breach a set level. These options often expire worthless, making them an attractive choice for premium collection when market conditions are stable. Asian options for average price trading. Asian options can smooth out the impact of price volatility. Selling these options can generate steady premiums since their payouts are based on average prices, reducing the likelihood of extreme outcomes. Calendar spread strategies. Exotic options with delayed or path-dependent payouts can be used in spreads to collect premiums at different stages. For instance, pairing a short-term standard option with a long-term exotic option might allow traders to profit from time decay. Customized yield enhancements. Exotic options can include features that allow for higher payouts but conditional risks. For instance, adding triggers or multipliers tied to specific events can boost income if those conditions are met. Deploying exotic options for income requires careful planning. It's not as straightforward as collecting dividends, but for those willing to do the homework, the rewards can be substantial. However, traders need to assess liquidity, fees, and the potential complexities of managing multiple contracts. Exotic options open doors to new possibilities, whether you aim to speculate or boost income. But as with any financial tool, success depends on understanding the fine print and using them strategically. The future of exotic options. The exotic options market is evolving quickly, shaped by changes in regulations and advancements in technology. This is creating both challenges and opportunities for traders and institutions. Understanding what's driving these changes can help you navigate what's ahead. Regulatory changes. How new rules could impact exotic options. Regulators around the world are becoming more focused on financial derivatives, including exotic options. Stricter guidelines could transform how these tools are traded. Increased transparency requirements. Governments may require greater disclosure from traders and institutions. This could include clear reporting on the design, pricing, and risks of exotic options. While this improves market clarity, it may add operational challenges for users. Standardization efforts. Regulators might push for standardizing certain exotic options. This could make these products more accessible but may limit customization, which is a key attraction for advanced traders. Restrictions on complex products. Some regulators could limit the use of highly complex exotic options, especially for retail investors. The goal is to protect less experienced participants from products that might be misunderstood or misused. Higher margin or capital requirements. Firms may need to set aside more capital for trades involving exotic options. This could make trading more expensive, especially for financial institutions. Cross-border compliance hurdles. Exotic options often involve international markets. Differing regulations between countries could complicate trading and settlement processes. These potential changes could slow the pace of innovation in the short term. However, they may create a safer, more transparent market that attracts broader participation over time. Technological advancements. How innovation is reshaping the market. Technology is playing a huge role in making exotic options more efficient, accessible, and precise. Here's what's happening. AI and machine learning. Algorithms are becoming sophisticated enough to price exotic options with greater accuracy. Machine learning tools are identifying inefficiencies and optimizing trading strategies in real time. This levels the playing field between large institutions and smaller market participants. Blockchain technology. Blockchain is introducing more secure and transparent settlement processes. Smart contracts could automate the execution of exotic options, ensuring they follow agreed terms without manual intervention. Advanced trading platforms. Next-generation platforms are integrating tools for modeling exotic options. Traders can simulate outcomes under different scenarios before committing to trades. These platforms also streamline access to complex products, making them easier to use. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.